what's your podcast about, man? I don't even know how to answer that question. It's about conversations. It's about speaking with people and having dialogue about, things that are going on around us, things that we see in society, and just having our opinion on those things and meeting different people and speaking with them, getting to know them, getting to see how different individuals think, how different individuals see life. That's what the podcast is really about, and that's what you're tuned in, hosted by the one and only Uncle Kevin. Hello. Welcome to Talking Finance with Uncle Kevin on the Conversation with Uncle Kevin podcast. Today you're joined by your host, Kevin. Yeah, man. I'd like to say welcome to you guys. How you doing? This is the first time that we'll be talking finance on this podcast with me, your friend, your boy, Kevin. I hope you're doing okay. It's been a crazy period of time that we've just gone through in 2022. It's hard to believe how the first quarter went and how the second quarter has started, because the first quarter, I remember in January was not a very good period of time, especially here in Canada, here in Vancouver. We had the lockdowns come back in January, which affected the economy pretty somewhat. A lot of businesses had to shut down. The vaccine passports were a thing, and that really restricted a lot of what we could do. But in the same period of time, I think it was in February where we moved on from having to wear masks inside, having to do a lot of these things, and that sort of stabilized the businesses, and we saw a lot of like film production rising up in Vancouver. We saw a lot of the business is starting to prosper and things starting to go back to a little bit of normal. And then in February as well, March, that's when the war in Ukraine began, which affected everybody. Like a lot of us didn't anticipate for that war to have any impact on us. People were making jokes of being called to come help, and that was what we all thought it would end at. Like the war was supposed to end within a week or something, but it's stretched out 2 months now. And no one really could have anticipated the impact it would have on our lives, especially on gas, with inflation already going up because of the pandemic. We were all not ready for that war to happen because the war affects supply chains. Russia is one of the biggest oil suppliers, and with their oil off the market, that impacted the cost of gas, because gas and petroleum and everything comes from oil. So we ended up in a situation whereby we needed more petroleum, and so the law of demand and supply, if there is more demand than there is supply, then the cost goes up. So that's the phase that we are in. That was the first quarter, and now we're in the second quarter. And then as well, we had in the first quarter the announcement that Elon Musk was buying Twitter. It's crazy the amount of things that happened in the first 4 months of this year. The past 3 years, the 2020 has just been different, man. 2020, the first quarter, March. I remember the pandemic started like in February. So it started in January. That's when cases were starting to be reported in Wuhan, and how Wuhan was going on shutdown. And then we're February. But then where I am in Vancouver and in Canada in general, we had to go into our lockdown in March of 2020. So nothing has been normal since that period, since 2020. Since 2020, 2021, now 2022. We're 3 years in, and a lot of weird things have been happening. I'm just looking here on my screen, and it shows me that the S&P 500 is literally down. It's in the red today. And Tesla's stocks, because of the pandemic, they went super high. A lot of people made a lot of money, but today they are down negative 6.4%, which is crazy when you think about it, how the world economy has worked. And I know for a lot of people, when people speak of finance, it makes no sense at all. It's like numbers and weird numbers. You're hearing all this. So that's some of the things that we'll be touching on in this podcast moving forward, just making finance sound normal, because I feel like finances really help us live better lives. They really help us understand what to do and not be left out, and depending on governments to protect us, because a lot of things that have happened because of the governments. For example, the war in Ukraine, that's just two governments going at it, but it affects the whole entire world, and other political leaders trying to get involved, not get involved. It's all political. So in this podcast, we'll be touching on a lot of that and seeing some of the education that we can take. With that said, our first topic of the day is we will be talking about the Twitter deal that Elon announced in the past month. I believe that he was going to buy Twitter. And partly what I really want to touch on is just to educate ourselves on how the deal is getting financed. Because a lot of us thought, especially myself, I thought that he was just going to go into his bank account and fork out, the $54 billion that the company was valued at. So if you're going to spend $54 billion and you have a net worth of 200 billion, you know what I mean? It's like, that's buying a $1 billion asset that's undervalued for what its value actually really is. But because in business, we're all about numbers, so Twitter hasn't been generating as much money to make it more valuable. It does have potential to become also $100 billion revenue business, $1 trillion business revenue. So if you're paying 50 billion, it's not really a lot for such a big platform. But as well, there's a lot of risk that's involved. Nowadays, the next big thing is always a click away, right? So we'll be touching into that. And the headline that Business Insider uses is very interesting. It's crazy when you read these finance papers. You have to question a lot of the writers because everybody's writing and they have an angle. In this case that we'll be reading on, it goes, Elon Musk just took out one of the biggest personal margin loans ever for his bid to buy out Twitter. Here's why Wall Street banks lined up to back this risky move. So the first thing that I already pick up from the headline is Elon is not using his money to buy Twitter. And that's very interesting because, the statement, it takes money to make money, becomes true. A lot of us, we try to ignore that statement, but it's the truth. Banks have a funny way of handling money. It's like, if you have 10,000 in your bank account, they'll gladly give you another 10,000. But if you have $0 and need 10,000, they'll gladly say no. Yes, I say gladly because they're super happy to do it. They're just doing their job, some people would say. But it's really sad, when you think about it. In this move, when you have money, they think to themselves, well, you already have money, so you need more. If you cannot pay it back, we'll just take what you have in your account as collateral. And that's just how it works. So in this case, Elon Musk is worth almost 250 billion. What's 50 billion? For them, it's like, we'll give him 50 billion and he can run it. And it's crazy how it works. It's the man is essentially buying Twitter without using his money, using your money, the people who bank with this bank's money. Every time you're depositing, that's the same money they just take and go give him to go buy Twitter. And within a couple of years, you can say 5 years, Twitter would have already returned its value and you would have paid off all those debts and left with a cash generating asset. And once again, the rich get richer. I don't really know about the poor because the poor, they have their money in the bank accounts, the same money that you are getting 0.25% interest on, that they're probably charging him here around 14 or 4%. I don't know. We will be looking at a 4 to 8% interest charge on a $50 billion loan. So if you think about it, let's dig into this article. So here's how it goes. Last Thursday evening, Elon Musk decided how he was going to finance his hostile takeover of Twitter. Hostile. He gave Morgan Stanley, his longtime bank, less than a week to come together with loans needed to buy the social media giant. A source familiar told the Insider. Listen, a week. How do you come up? Listen, I don't know about you guys, but sometimes it takes me a month just to come up with rent. How you going to come up with $50 billion within a week? But then that's an opportunity to make money because these are big deals, man. 8% on a $50 billion loan over a period of time is good returns for anybody, man. So in 6 days, Morgan Stanley finalized $25.5 billion worth of debt commitments, which were revealed in the SEC filing today. So this included 12.5 billion secured against Musk's Tesla stock and another 13 billion that will be lent to Twitter if Musk succeeds. So, oh yeah, and then Musk agreed to cover the remaining 21 billion, but I don't believe this is true. I think of the total deal, he is only going to pay around 13 billion by selling his shares, which he already did. And then the other one is secured from another bank, must be Citibank or another type of bank like that. I'm not pretty sure which one it is. But then the thing is, this is a very they say it's a risky move that they're doing because these margin loans are, once you're basing something off of a volatile asset like a stock to give someone money, it becomes tricky because if they're going to give him $12.5 billion margin loan based on his shares, the question is what happens when his shares start to dip? And we've seen this, in the past few weeks, that the stock market has been going down, Tesla stocks has been going down. So that could hamper the deal because the deal is based on the value of the shares today. So if the shares start to fall off, moves will need to be made. They have smart people who come up with the numbers and they have an understanding of what needs to be done. It's a lot of times these articles are just written for clickbait and to make sure that we read all of them, but a lot of times it's just spooking you out. These people sit down, they understand the risk, they see the ways we can mitigate the risk and how we move forward. What's very interesting is this article, I'm pretty sure it was written on the 21st of April. This video is being recorded today, which is the 16th of May. So in that period of time, the deal has not progressed as such. It was put on hold. I do believe last week Elon Musk tweeted that he was going on hold just to make sure they understand that the number of people on the platform, because it was reported that 5% of the people on Twitter were spam and bots. So what that does is it affects the value of Twitter. So if they were going to pay Twitter $54 billion based off, say, 100 million users, and 5% of that 100 million, that's almost 5 million accounts are fake, it affects the value of Twitter. And Twitter right now, as of today, was trading at $38. So they will be paying a lot of money for non-existent people. So that's what he tweeted. But the truth is, the financing of the deal has been tricky because with the Tesla stock, because Tesla, they invested a lot of money in Bitcoin. And we just had a crazy meltdown in the past 2 weeks in the crypto space. So that affected Tesla. And then the shares of Tesla are going down, which starts to affect this loan, which brings us to the next article. Again, by Business Insider. I feel like they're not really happy about this deal. Here's what it says. Elon Musk's Twitter deal is looking shakier than ever. Here are all the ways the buyout could collapse. So essentially what they go to say, Musk's takeover relies on a $12.5 billion loan secured against his Tesla shares. By plummeting tech stocks have hampered this crucial part of the deal. Tesla has slumped more than 20% to $769 since the loan agreement was signed. If it falls below about $420, Musk would not have enough unpledged Tesla stock to cover the margin loan. This creates a foreboding thought, not unavoidable risk for Musk. He's raising an additional $7.1 billion from CWUK Capital, Qatar Oracle fund Larry, and Saudi Prince Alawad bin Talal, whittling the margin loan down to $6.25 billion. Without that, Musk would have already run out of collateral when Tesla dropped beyond $837. So the thing is as well, I don't think the deal has a major risk to fail in terms of financing, because what I feel will happen is if he cannot secure the loans from the banks, then there are a lot of billionaires out there who will be interested to jump into the deal with him. But I guess for control, he will not be really up for that, because the last thing you want is to take the business private and have business partners that you don't really like. And what's the point, A lot of people have bet that the deal will fail. And so people have been shorting and stuff like that, which is very tricky to do with a guy like Elon because he never gives up in it. And a lot of people have lost money for doing that, for betting against him. So I would not. But at this point in time, I would say if you have money, man, and you can buy Twitter shares, I don't know if they're still traded and you can still buy them, man. Because if you buy something for $38 and they'll sell it for 54, come on, man, that's a good profit. With that said, we'll be moving on from this deal. The one thing that we learned from it is, the sentiment that I share with a lot of people is debt is bad. But the thing is, when you have money and you're using debt, to buy assets and you have the money to cover the debt just in case, I feel that's a win-win because if you buy a cash generating asset on debt and do not have to use your cash, it's more of like you're leveraging the amount of money that you have to get an asset on debt, and then that asset pays itself. In the end, you just added to your assets without touching your cash, which is amazing. This is something that banks do, but banks are a little bit trickier because how banks operate is we put in our money into the banks, they take that same money, go and give to entrepreneurs to invest and build economies and do whatever. Get money, get interest from that same money, your money, and then when it was made is they would share the same money with you. But nowadays, if they're making 8% off $1 billion and they're giving you 0.5%, man, it's just a tricky thing. It's a deceptive system that we work with. But at the end of the day, the problem with business, especially big business like banks, is they have a fiduciary duty to their shareholders. So in the essence, everything is made for the shareholders. It's not for the customer. It's not for the service provision. It's to make sure shareholders make money. It's unfortunate, but it is what it is at this point in time. All right. The next headline that we'll be working with is 1 trillion crypto meltdown. Huge crash wipes out the price of Bitcoin, Ethereum, BNB, XRP, Cardano, Solana, Terra, and Avalanche. Bitcoin and cryptocurrencies have crashed further overnight, dropping to levels not seen since the crypto market began surging in the late 2020 and wiping away almost $1 trillion worth of value in a month as a serious ripple warning comes into effect. Man, crypto, I did a podcast about crypto at the end of last year, and I spoke about this, how the challenge with crypto is it gave a lot of people who did not have money hope. I remember seeing there was someone who was called a Doge millionaire who refused to sell his Doge coins when they were going up, which I would have done, man. Once I hit $1 million, I'm out. But he held on, and then it started losing its value, because Elon Musk was pumping it and stuff like that, and it started losing its value. And unfortunately for a lot of people, they lost money because a lot of people got into the game too late. They got into the game once the cost was higher up. And the problem with crypto is a lot of times the people who make money out of it are people with billions of dollars, like big corporations who are capable of buying. So, for example, right now, when Bitcoin and other cryptos are losing value, if you were to invest $1 billion into Bitcoin at 27,000 and it starts going up again to say reaches 52,000, and you've put in $1 billion worth of cash to get them, you stand to profit more. But the people who suffer a lot are people who are taking their check-to-check funds. You earn $500 and you're just trying to double that as quick as possible through crypto. Imagine if you had bought into Bitcoin at 52,000 and I'm coming in today to tell you it just dropped down to 27,000. Man, that's that's almost 40% in value lost just like that. And that's the sad part about crypto, is because it's very volatile. It's a volatile asset, and it's something that's hard to understand how it works. Like, people can tell you there's this blockchain technology, there's this and that. But the thing is, unless you read and you're really entrenched into the crypto sphere, it's very hard to understand where the value is derived from, how these things go up and down. Is it all speculative? Is there room for investment for the long term? I mean, I had someone try and explain to me how NFTs work, how this works, and I'm game for all of it. I'm in support of all of it. But I'm just fearful of things that I do not understand. For me, I'm a business major, so I really do understand business. I understand how to value a business and how the stock market works. But in terms of crypto, it's a new technology that we are all still learning. And the challenge is it's not a get rich quick scheme, I think. It'll end in tears if you do something like that. Like, I mean, $1 trillion was lost, man. Like $1 trillion. Like, I don't know, man. The Bitcoin price has dropped to around 27,000 per Bitcoin, down 12% on the last 24 hours, and dragging down the wider crypto market, with other top 10 coins, Ethereum, BNB, XRP, Solana, Cardano, and Avalanche recording even steeper losses. Ethereum has now crashed 22% since this time yesterday. 22% within a day, like within a 24-hour period. 22%. Imagine if you have $1, it's now worth 78 cents. Like, you go to sleep with $1 and you wake up with 78 cents. That's what this means, man. With BNB, Solana, and Cardano all losing between 25 and 33%, fam. This is a tough thing. The sell-off comes after the 18 billion algorithmic stablecoin Terra USD lost its peg to the US dollar, wiping out the price of its support coin Luna, which has now lost almost 99% of its value. Almost 99. You went to sleep with $1 and woke up with 1 cent. I don't even know. Like, I keep telling people, like, crypto will end in tears if you don't understand what you're putting your money into, and if you don't keep yourself educated and looking at what's going to happen, because you don't want to be hit unaware. You don't want to be hit unaware. You need to always constantly be vigilant and constantly educating yourself on what's going on in this world. Otherwise, you'll be left holding the stick, and that will be a very, very sad day when it happens. All right, we'll be moving on into the next topic, which is there is no relief in sight for high gas prices. With gas prices averaging nearly $4.50 per gallon, out here it's almost $2.14 per liter. That's in Canada. So picture this: a year ago we were paying $1.18, for gas, and now it's $2.14. That's almost 100% increase within a year. And yeah, it's crazy. But gas prices seem likely to go higher and maybe break the $5 on average as Russia oil disappears from the market and producers struggle to keep up with the demand. And yeah, with everything happening, the pandemic and the war, it's a very terrible time right now in terms of gas and driving gas cars. According to this guy's expectation is it's going to get worse for consumers. Spare capacity is at a multi-decade low. New production is insufficient to meet demand. Oil is going to continue to stay at high prices, and gas prices will stay high as well. I always found it funny. Like, in North America, they call petroleum gas. Like, you're like, yo, that's not gas. There's actually real gas, like natural gas and stuff like that. So it always amazes me when you run into these situations, But the world, I don't know if things are going to get better, because we need productions to be ramped up. And with the war happening in Ukraine and Russia, it's very difficult to see when that war will end, and then for it to end and things to go back to normal for countries such as Russia, for them to be able to start again to produce the oil that the world needs. That might take a little bit of time, and then inflation and prices tend to go up, they rarely go down. So it's very difficult to see how the world will moving forward. But I'm here for all of that to see what's gonna go on. Yeah. With that said, man, we move into the next chapter, which is basically a word of advice when it comes to your finances. It's don't count your chickens before they hatch. Drum roll, please. Yes, sir. Don't count your chickens before they hatch. When it comes to your finances, try to make sure you don't make plans for money you do not have. Do not make plans for investments, for thinking that, well, when I make this move, I'll do this, I'll do that. Don't count your chickens before they hatch, because you never know. We woke up, $1 trillion was wiped off the crypto market. Right now, the S&P 500 is down. The whole global economy is just a mess. So don't count your chickens. In 2019, I had plans for the 2020s. I was calling myself, I'm going to be great. But yeah, the world said no. With that said, I hope you guys enjoyed this podcast. Let me know which other topics you'd like us to check out in the coming weeks. We'll be releasing podcasts every Monday, Wednesday, and Friday, talking finance, business, and life. With that said, I'll see you guys next week. Bye-bye.